The hidden history of HELOCs. Sarah and James used to be proud of their 3.5% mortgage rate. This is until they learned how much interest they would be paying over 30 years. So why doesn't anyone ever talk about paying for a home using a HELOC? Sarah began her research. Did you know that home equity lines of credit, especially first-lien HELOCs, have been common financial tools in many countries for over a century, but are barely used or promoted in the U.S.? Here's why. Before 1913, most Americans paid cash for homes or used simple interest-based loans, often held directly by the seller or local banks. But that all changed with the creation of the Federal Reserve. At the same time, the U.S. banking system adopted fractional reserve lending, a system that allows banks to lend out more money than they actually have on deposit. Fractional reserve lending created a new profit engine for banks. But for it to work efficiently, banks needed people to hold money in checking accounts, not use it to immediately pay off debt. So the financial system evolved to encourage fixed 30-year amortized mortgages with more interest over time. Separate accounts for income, bills, and mortgage payments. And a culture of debt segregation, where your income and your debt don't interact. This created more interest income for banks. Instead of using your income to immediately offset debt, as in a HELOC strategy, it sat idle in a bank, benefiting them, not you. Why HELOCs are different and suppressed? In contrast, a first-lien HELOC acts like a hybrid of a mortgage and checking account. Your income goes into the loan, reducing principal immediately. You pay interest only on the balance, not a fixed amortization. You can access the equity if needed without refinancing. This strategy can slash years off a mortgage and save tens of thousands in interest. So why is it not widely promoted in the U.S.? Because banks make far less profit on a first-lien HELOC than on a traditional mortgage. In countries like Australia, Canada, and the United Kingdom, using lines of credit to manage mortgages and cash flow is far more common. Homeowners often have flexible, revolving accounts tied to their equity. But in the U.S., these tools are underutilized, largely due to how the financial system is designed. Lessons learned. The first-lien HELOC is not new. It's actually been hiding in plain sight. Its low interest, high flexibility design doesn't fit the profit model of U.S. banks post-1913. But for disciplined homeowners like Sarah and James, it can be a powerful alternative to traditional mortgage debt, one that banks hope you never learn.